Global investing, benefits and risks. Today we will discuss investment in foreign securities as part of a global investment strategy. With the digital age, global travel and internet, economies in the world are becoming much smaller and more like a global village. Investing should not be narrowed down to a single country. Unfortunately, U.S. investors do have a bias when it comes to investing. They like U.S. stocks. In today's globally interconnected economy, many people are investing in stocks from around the world and don't even know it. For example, FANG stocks, Facebook, Apple, Amazon, Netflix, Google are popular U.S. companies to invest in and are global companies. On average, 3/4 of the stock portion of a U.S. portfolio are made of U.S. stocks, even though they only make up a little more than half of the stocks worldwide. Now, more than half of the world's market capitalization lies outside of the United States. Why would you want to limit your investments only to U.S. equities? Investing globally or internationally can serve different purposes, like diversification of a portfolio, opportunities for loftier returns, or increased stability in the portfolio. Diversification is the most obvious, most crucial benefit of global investing. Diversification is one of the primary reasons that investors are shifting their focus from domestic markets to global markets. The rationale is clear. Domestic equities tend to be more exposed to narrower economic and market forces of their home market, while stocks outside an investor's home market tend to offer exposure to a wider array of economic and market forces. These differing economies and markets produce returns that can vary from those of an investor's home market. Investing in foreign securities has diversified the returns of a purely domestic market portfolio on average and across time. Diversification through investing through different countries and geographies could reduce the risk. Even if the economy of one country takes a dip, the value of your portfolio may be affected only to a limited extent. Your holdings in foreign securities may not be affected much because the entire geography changes here, and usually the correlation between different geographies is on the lower side. They also offer a chance to add to your portfolio by investing in foreign companies that have different economic drivers and different characteristics than American companies. Global markets don't tend to mirror the U.S. markets, so when U.S. markets are down, international markets could very well be up. The benefit of global diversification is the opportunity to participate in whichever regional market is outperforming. This is a critical component of diversification that correlation does not effectively capture. For example, while the United States may lead over some periods, another country or region will invariably lead at other points. At a high level, the benefit of global diversification can be shown by comparing the volatility of a global index with that of indexes focused on individual countries. In this slide, we show the benefit of diversification. While the United States had the lowest volatility of any individual country examined, its volatility was slightly higher than that of the global market index. Other countries examined had volatilities that were 15% to 100% greater than the global market index. By its very nature, global diversification helps to reduce the concentration of risk of investing in the same asset classes or one region. That potentially equates to a smoother ride over the long term of your investments. We've looked at the upside, now let's take a look at the risks. Before investing in any economy, the investor should consider the bilateral relations and the geopolitical environment of the country. The reason being, if relations are not good, then any political decision may adversely affect the investment done in that country. Political events affect the domestic markets of the country and may lead to volatility. In developing markets, government and policy decisions could hurt even the most prominent companies. We have seen this frequently in countries like Brazil and Argentina. Fluctuations in the country's currency your investments are in can also impact your bottom line, especially in emerging markets like Russia. Those fluctuations in the cost of converting the currency to US dollar can also erode your earnings. Certainly, those fluctuations can go both ways and work in your favor as well. The most significant barrier to investing in global markets is the added transaction cost, which varies depending on the foreign market you want to invest in. There may be additional costs like foreign currency conversion charges, transfer fees, annual maintenance fees that you should be aware of. In conclusion, international investing has become a component to achieve strong portfolio diversification. While the benefits are lucrative, you must pay attention to the risks as well. In today's globally interconnected economy, it could make sense to broaden your investment strategy. Benefits those global investments provide may outweigh their limitations.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.